Cummins looks to be trading at a better value right now than Caterpillar. So is this an undervalued buy with some significant upside? We're going to analyze Cummins as usual in today's episode. We're going to run through their income statement, top line revenue, as well as their bottom line net income growth year on year. We want to see how healthy the balance sheet is, total cash versus total debt. We also want to analyze how they've performed versus some well-known competitors such as Caterpillar, Deere, as well as Dharma Truck Holding. And we want to take a sneak peek at what the institutions are doing, whether they are buying or selling this company. And as always, we will look at their dividend safety and some very strong financial metrics that this company holds. And as always, we will run them through our stock valuation model, getting to our intrinsic value and our acceptable buy price given our investor margin of safety. Now, we'll also recently touch upon their quarterly earnings too. So year to date, they are down around 6%. They do offer a forward yield of around 3% and trading towards the mid to lower end of the 52-week range. Now, investors who have been holding the company over the last 10 years, well, they'd be up 70% without those dividends reinvested. And we can see it did hit its peak around March 2021, around $273. So let's find out whether this company will blow through that figure and see that yield on cost grow to double digits. So top line revenue, as always, 3 to 7% year on year is what we're after. 24 billion reported in December 2018. December 22, 28 billion. So nice growth over the last 5 years. And on top of that, the trailing 12 months is showing signs that when we see the December 23 report, there will also be some nice growth. Now, one thing to note when we do take a look on a more granular level, the top line did drop to 2019 and then to 2020 before bouncing back very nicely in the subsequent periods, and it looks to be the same in 2023. Now, when we look at the story of the bottom line, we see it's gone from around 2.1 billion to 2.1 billion again in December 22, so it has remained flat over that 5-year period. And on a more granular level, what we see is a very small increase to December 2019, and then a drop to 2020, you could argue due to the COVID year, and then it has picked up in 21 and then remained relatively flat. Although similar to the top line, we are seeing that trading 12 months showing some nice signs of growth. So the story with the income statement, it has grown over the last 5 years in a nice way, in my opinion. Nice growth. We'll look at the last 10 years percentage-wise, but in the middle of that, there have been some inconsistencies with some peaks and some drops. Now, in terms of the health of the company, total cash versus total debt, we can see 1.5 billion of cash sitting on the balance sheet and short-term investments. In 2018, latest quarterly report showing 2.8 billion, so their cash position has increased. And when we take a look at their total debt, what we do see 2.5 billion to around 8.1 billion. So even though their cash has increased, we also see their total debt increasing quite significantly, and we'll touch upon that when we look at our net debt to EBITDA as well as other metrics. So on a total return basis year to date, remember it includes those dividends reinvested, Cummins is down 4%, one of the worst performing of their peers, only second to Deere, which was a negative 12%. Now, when we extend that, as we always like to do, to the last 5 years, the story that we can see in actual fact is that over the last 5 years, Cummins is in actual fact up 76% in the middle of its peers. And when we do take a look at the more well-known, like Caterpillar up 123% and Deere up 167%, we do see they have underperformed Cummins. But as always, do remember that past performance is never indicative of the future, and it always does significantly depend on what value you have purchased these companies. Now, institutional ownership sits at 82% for Cummins, with around 3.6 billion of sales by these institutions over the last 12 months, and nearly double the opposite direction, so buying inflows of 5.6 billion over the same period. And when we look on a more granular level, quarter by quarter, we see all 3 quarters of 2023, green depicting inflows, red outflows, that the institutions are buying more, and that does also extend to Q4. So over the last 4 quarters, institutions have been buying Cummins more than they have been selling. Bear in mind though, we should not copy what institutions do and always do our own due diligence. Now, before we jump into the dividend safety and financial metrics, let's take a very quick look at their earnings. So September 23, earnings per share 469 expected by Wall Street analysts. They actually came in at 1% positive, so that was good to see, plus 5 cents per share. And on the top line, a very nice increase of 8.18 billion expected, 8.43 reported, so 3% jump than what was expected. So that's very nice to see. Now, what is more important to me than what Wall Street target is the jump from quarter 3 23 to quarter 3 22. What we can see, revenue top line up 15%, net income up 64%, diluted earnings per share up 63%, and bottom line margin as well as operating income all up. So very, very strong signs that this company has grown over the last quarter to quarter. So that is positive. In fact, Q3 23 versus Q3 22. Now, dividend safety score 98, very safe. Market cap 32 billion. It is a large cap company. Now, recessionary metrics, well, increased the dividend over the last recession, 07-09. Now, they had below average growth of companies in the S&P 500 at negative 27, and they also severely underperformed the S&P negative 71 versus the S&P's negative 55. Now, dividend growth is one of the things I do like about Cummins. 7% in July this year, above that minimum 4% I always advocate on the channel. Plus 7% over the last 5 years on average, and double digits over the last 16 years, 16% every single year. We love to see that, and I'm not surprised to say that I don't believe the majority of people will be getting 16% increases in their salary or other income producing assets, so that is always positive to see that from your dividends, and they have been paying increasing dividends over the last 17 years. Now, dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. So 2.98 versus 2.7, you could argue reasonable valuation / undervaluation. And we see the forward PE sitting at 11.9 versus the 5-year average of 12.5. Now, when we want to compare that to the sector PE, it is significantly lower at 11.9 versus the industrials at 18.6. And it is trading towards the mid to lower end of the 52-week low. Now, quick analysis of the free cash flow payout. We don't tend to look at the earnings. It is susceptible to manipulation by management through accounting. Now, personally, for the free cash flow, I do look for below 60%, as it means management can offer those double-digit increases. But what we do see, we can bring that down to 40% for heavy equipment makers. And over the last 10 years, it has been around that 40% on average. Although do note the last 2 years, it has crept up. Bit too high for my liking in that 2022 at 82%. But it is expected to come all the way down to around 40% in 2023, so I can personally live with that, but it might be something to keep an eye on. Free cash flow per share, 721 to 2022, 739, so it has remained fairly flat over the last 10 years, but when we look on a more granular level, we do see that it has increased, but then has come down, with 2023 expected to go up. So do note that whilst it does move in the right direction, it does have some inconsistencies year on year. Now, sales growth, as always, we love to see double-digit increase, 3 to 7% as a real borderline minimum. And what we can see, and I think you could argue that this industry is very cyclical, so we do see some years of double-digit growth, followed by years of double-digit negative growth, and so on, the cycle recycles. Now, remember, with cyclical industries, you do want to be buying when they are out of favor at the bottom, so you can ride them when they do get in favor and are trading at high prices. How this translates numerically, the sales, well, 17 billion in 2013, 28 billion in 2022. So it is increasing. Again, slight inconsistencies, but it is moving in the right direction. And we always love it as investors when companies are doing share buybacks, putting excess cash to our pockets. And what this translates to is 187 million worth of shares in 2013, 142 in 2022. So that is a great sign of a company. ROIC, as always, 10% or more. Over the last 10 years, it's been above that. And the last 2 years, it's 16%, with the trading 12 months at 18%. Gives me a lot of faith in management and their ability to effectively allocate their capital. Now, operating margin is one metric that we have come to that we can see they do struggle. Above 15% for the industry of the heavy equipment makers. Although they have kept it consistent, I do like to see consistency, but I would like to see this start to increase up to the 15% level. But one thing is, it has been consistent and has been performing well up to now. Free cash flow margin above the 5% we look for, although whilst it has slipped in 2022, 2023, in fact, the trailing 12 months does see us 7%, so we should be expecting an increase in this next new year. Now, net debt to EBITDA, this does follow the dividend safety, earnings before interest, tax, depreciation, amortization. And remember, we are looking for below 2.5 for the heavy equipment maker industry. Now, for those that are new, these numbers signify the number of years it would take the company to pay off all of their debt net of cash on hand. So whilst this is significantly lower, on top of that, it is expected to come down even lower to around 1 in 2023, which does essentially strengthen that very high and very safe dividend safety score. So that is Cummins Inc. And now let's jump into our stock valuation model. And as always, if you do enjoy the content, value is being provided, then do smash that like button. It takes a lot of time to get all of the data to build these essential valuation models and analysis. Smash the like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And if you do want to grab a copy of the intrinsic value calculator that we're about to run through to get to your acceptable buy price of companies in your own portfolio or on your watch list, then do click on that pinned comment below. Jumping into the first model, Graham's valuation, we have the stock ticker symbol CMI, earnings per share 964. PE of a company with no growth at 7 always stays the same. Growth rate per analyst estimates at 11, with that current yield on AAA corporate bonds at 5.04. Remember, the higher the yield goes on AAA corporate bonds, the lower the intrinsic value. And this is coming to $309 based on Graham's valuation, significantly higher not only than the current trading price, but above the 52-week high, showing some nice signs of undervaluation of Cummins in the current market. We then move on to the second model, which is the multiples valuation model, companies in a similar sector and size. We have Deere, Paccar, Caterpillar, all ones that we analyze on the 5-year total return. We have their stock price, earnings per share, PE multiples, of which you get the average, multiply that by the earnings per share of Cummins to get a stock price of $241. Now, when we take a look at that, there is some nice upside to the current trading price, around 10%, but it isn't higher than that 52-week high. Nonetheless, it shows signs of undervaluation. But always do keep in mind when we run through these models, we're not looking at any of these models in isolation and drawing our conclusions towards the end. The dividend discount model, the DDM, where we have our yearly dividends, very nice growth for a company over the last 5 years. Average growth, we see around 8%. Forward looking, I've gone for 5.5. You can justify higher, you can even justify a lower. So grab a copy of the model where you can play around with all of these estimates and judgments. But based on mine, we get a DDM price of $284, above the 52-week high, so another sign of severe undervaluation. We then move on to the fourth and final model, the DCF model, where we have our free cash flows year on year. Analysts estimating 10% forward looking. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, and we get to the equity value, divide by shares outstanding to get a DCF price of $201. Now, this is right there at that 52-week low, showing signs of some slight overvaluation to the current price based on the DCF model. Now, the intrinsic value, as always, is just the average of these models. And if you are enjoying the content, value is being provided, do smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. So what we have now then is the current price, as we can see, coming to $259. Current price around $225. As always, or for those that are new to the channel, we start off with 10% margin of safety, which I would apply if I believe the company has a wide moat, strong financial metrics and good forward-looking data. So it's a buy up to $232. Now, if we use 15%, and this really comes down to your own investment thesis, you would be looking at a buy around $219. So right now you are getting between a 10 to 15% margin of safety. And for those who are looking for a 20% margin of safety, your acceptable buy would be around $206. And we can see that's right there towards the 52-week low. So right now, for Cummins, you're getting between a 10 to 15% margin of safety, and Wall Street forecasts the price over the next 12 months to hit roughly right there, in fact, at our intrinsic value at $258. As always, though, do let me know your thoughts in the comments below, whether this is a new stock that you have just seen today, whether you believe that it's one that you should add to your portfolio, or whether you hold it or sold it in the past. This does look to be undervalued, and in comparison to Caterpillar, which looks to be slightly overvalued currently, this could be the better choice if you were looking for a company in this industry. As always, though, if you enjoy the content, smash the like button, hit the subscribe and bell. If you do want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio, or on your wish list, then do click on that pinned comment. As always, drop your comments below. Have a great day. If you want to join us in the Discord, then do click on that Patreon link below, and catch you on the next episode. Take care.